Live streaming is on.
Ladies and gentlemen, you know what time it is. It's that time of the month in which we bring in our trading team and host our trader strategy meeting. We've got the likes of Blue Chip and Chart Trader, Trend Tracker, Scalp Trader, and of course, Event Trader jumping on to talk about some of the themes that we're going to see over the course of the next couple of weeks. And as usual, we're going to start things off with Brett Manning. The one thing I do want to remind our whole team is that we tend to have our best format when we have a nice roundtable discussion. So I encourage you guys to jump in, chime in with any questions, comments, rebukes, what have you. And we will have what I hope to be a fairly good conversation about some of these themes. So I'm going to start with Brett Manning, aka Chart Trader. You guys know him well, and he's been at it pretty active today. Brett, how are you this morning?
I'm doing pretty good, Jim. How are you?
I'm doing all right. You had a few good trades out there too. Some
Oh,
crude
thank you.
oil, and you're still short the Dow. So, um, before we get into some of the macro themes, what are you seeing that perked you up as far as activity today?
So I'm also still short the S&P futures from Friday, and I am bearish on the market right now, and I see a lateral triangular consolidation playing out in the indexes that is likely to lead to another leg lower. Obviously, in this environment, I mean, one caveat we can throw on everything today for this strategy meeting is everything that anybody says in this meeting today could be totally moot tomorrow because everything can change on a single big headline. And it all really has to do with the contents of one man's mind over in Russia right now. And it's impossible to analyze one person's mind from halfway around the world. So you just know whatever your base case is, whatever your conclusions, whatever your bias, it could be totally moot tomorrow. But inside of that, my instinct tells me that we've got another leg lower and that we're building toward that. And I've been positioning that way. The gap up into Friday morning was a really good gift in terms of getting some of that short position on. Today's rally was another gift. So I've got ES and YM short. And I also still hold gold long. So yeah, I mean it's been a really terrific intraday trading market, but there's also some swing potential.
All right. So that sums up the most recent trades. As far as your overall perspective, I guess we got to start with Russia and Ukraine and what your thoughts are as far as the market's response to that.
Yeah, so you have to have a view on this, but it's impossible to have a high conviction view for the reasons that I've just described. So anybody, no matter what we say about the situation, I mean, the whole everything in the market right now is clearly hinging around the narrative in Ukraine, and it's by far and away the most important factor. And it's a huge sort of there's one world that extends on this side of it, and there's another world that extends on the other side of it, depending on how things shake out. Everybody knows it, and the market's going to react to that the most. And everybody's got to have some view on the situation, but it's impossible to have a high conviction view. So that's where we're starting. But my view, again, not a high conviction view, but it's the view that I have, is I really don't think that Putin has an off ramp. I really think that every time you hear something about talks, it's just something to fade. I think this went really wrong for him. I think it's a classic case of failed organizational strategy. I think he surrounded himself with people that would only tell him what he wanted to hear for a long time. And his intel and his data were very, very poor as a result. And he bet the house on this move under those conditions, and he lost. And now we're kind of dealing with the environment of how that shakes out, given this situation, and given how much control he has over what's expressed publicly to a domestic audience in Russia. But I think he's starting to lose control of the narrative at home. I think there's a number of signs of that. So there's a couple points there. One would be um, recently he started to publicly blame the FSB. That's scapegoating. You don't scapegoat unless you have data showing you that you're losing the public. We've seen polls recently that talk about how overwhelming the support is for the special military operation among Russian citizens. But in my opinion, given everything that we've seen from this centralized form of government, you have to see those polls not as information about what the public thinks, but as marketing material that Putin wants people to think, both at home and around the world. He probably just made the data up at his desk, and the fact that he's blaming the FSB publicly now, again, is scapegoating, and that suggests that the real data that he has is showing that it's starting to be impossible to prevent people in Russia from seeing all these images and from starting to realize what's actually happening there. But, and I think it's a huge point, this in no way means that he's losing power. This just, I think that there's so many of these sort of autocratic police state situations that can go on for decades, with very repressive central governing apparatus, no free press, a lot of control. I just feel like that's where this is headed for Russia. I feel like that's what the end result of all of this is going to be, to create this descent into a much more sort of autocratic police state kind of repressive apparatus to govern that country. And they're just completely isolated now. And I can't imagine an outcome of this where that's not the long term situation. But again, there's no way of knowing if any of that's true. It's where I'm at with this. And I think there's a lot of repercussions, including the possibility of a stagflationary growth shock that looks harder and harder to avoid, which is one of the reasons why I've just continued to kind of be bearish. But at the same time, for traders, if you're active, it's been a really interesting volatility period, and it's been a really remarkably fruitful trading environment. And one of the consequences of that is, the last time we did one of these strategy meetings, I was doubling down on my idea that the long crude oil campaign was going to really pay off, and this obviously massively accelerated that result. I ended up closing that position out at a little bit above $120 a barrel in oil, and that's way above where my outside positive target was on that position. So we took advantage of that. We've also made nice money along the gold position, and there's been a lot of active two-way trading in the futures. But yeah, again, so the situation in Russia has enormous consequences. Nobody knows how it's going to turn out. But for me right now, my base case is that this is not going to resolve itself in any constructive way. That there's to me, there's very little chance of that.
And it feels like you are already positioned for what you've laid out. Being short the market, you were long oil, you're long gold. Um, so, is there anything else that you might position in, maybe bonds or anything else that you might throw up some type of structured trade at?
There's a number of possibilities, including other commodities on the long side, because that's one of the big consequences. These are powerful trends. Uh, Certainly, short bonds is another one, because now the interesting thing that we've seen is the we haven't seen any real resolution at all in Ukraine, but bond futures are back at their lows for on a multi-year time frame. So that you'd think that there'd be a flight to quality bid that was suppressing long end interest rates, and to see that start and then so clearly fail is probably a very strong trend indicator, probably a very strong indication that interest rates at the long end are going higher. That's probably a really reliable view, and it just takes the right kind of setup with a falsifiability level and the ability to control risk for me to put that one on. But that's certainly there. I also think that people have been malpositioned in the yen, because Japan has to import absolutely everything, and the yen was a traditional hedge. By the yen, when volatility goes up, it's a really standard position, and the yen is starting to get smashed now. So there's probably a lot of people on the wrong side of that. That could turn out to be a really strong trend as well. There's also agricultural commodities on the long side, and then there's just this sort of repeated process of shorting the hopium when equity index futures start to pop up on something that really looks to me like an improbable or implausible catalyst.
Yeah, and you've been all over that in most recent weeks. So nice trading there. And again, you've got a nice one already, or two nice ones already in that S&P and mini Dow. So we do have a Fed meeting on deck. We'll get the latest update on Wednesday. But I wanted to get your thoughts on what the base case scenario might be, and this might be an opportunity for Event Trader to chime in too, because he always has some thoughts, and you guys always get a good conversation going. So I'll kick it off with you, Brett. What's your thoughts on the Fed?
So I'm sure we'd say pretty much the same thing. They've cornered themselves into a 25 basis point hike. There's a decent chance of a 50 basis point hike in on March 4th to follow that up. And I think that they're
Oh, wait,
very
on
aware.
when? On
March,
March 4th.
or sorry, May 4th. May 4th. My bad.
Okay.
Yeah. So they've got the March meeting here. We've got another one coming May 4th. If you look at the Fed funds futures, there's no chance they're going to do 50 this time. There's a good chance they're going to do 50 next time. And what's happening in China right now is going to be a factor in that because we're starting to lock stuff down again. Even though they started to talk about moving away from a zero COVID strategy and moving to a manage and mitigate strategy, they just locked down Shenzhen. They've got tens of millions of people in lockdown again, and they've lost control. There's no way that they're going to regain control over community spread with the Omicron variant. But they're still doing the lockdowns. That's still going to bind up supply chains. That's still going to push peak inflation out further. That still means the Fed needs to do it with policy to stop. We just saw 3-year inflation expectations pop up to 3.8%, which is multi-decade high. So it's starting to metastasize into expectations, and the Fed knows that's a huge red alert. And even in the face of what's going on and the volatility and everything else, there doesn't seem to be much of a Fed put, and the growth shock is likely to be stagflationary this time around. And the Fed pretty much has made its bed. So if China's going to continue disrupting supply chains to fight a losing battle against COVID, that means their peak for the Omicron wave is going to be pushed out till mid to late summer, which means it's going to be a long time before you really get the Fed saying it's transitory again. And, I mean, I suppose that there's some theoretical Fed put. We just don't know where it is. If things get bloody enough on the street, it's possible that will shift their tune. It's also possible they'll see the growth shock coming. But again, you cannot let these price increases metastasize into long-term increase in inflation expectations. They can't do it. That's a multi-cycle problem that they're building rather than just one bad cycle. They've already got the bad cycle. Now they've got to make sure that it doesn't become something that's staining the environment for another decade and a half.
All right, Event Trader, do you agree with that assessment?
Yeah, I think Brett's right on the money for it. I mean, it'll be interesting to see how Powell addresses this in 2 days. We saw the ECB push forward with a little bit more hawkish language. They brought up the wind down of their APP by a quarter, and that certainly caught some attention. And like Brett said, the Fed's kind of painted themselves into a 25 basis point hike here. Uh, the bigger question for the market is going to be keeping an eye out on the forward looking dot plot as well as the inflation outlook for these Fed members. Um, Now, granted, the Fed's projections haven't been right on the money, so there'll be some question marks. But in terms of how aggressive of a rate cycle the Fed wants to get into, that'll certainly be closely monitored. And to get that, the dot plot will probably provide us with, the best temperature of what's going on in the room there. But they're in a tricky situation here. I saw the Atlanta Fed GDP outlook for Q1 is down at 0.5% now. So that makes it tough area for them to be raising rates aggressively as they probably want to. So that's something that we have to bear out. I'll probably keep them trying to remain vague in their commentary in the Wednesday meeting, and that's not necessarily going to be a positive for the markets at all. There'll be a lot of questions about the balance sheet, the balance sheet wind down. I think that they'll look to kind of punt on that, and the Ukraine situation and China situation certainly give them the ability to do that, but it's just not going to go over great in the market because the market wants to get a little bit more comfortable with how many rate hikes that they should be expecting going on into this year. We've certainly seen that rise up with camp, probably the baseline falling close to that 5-6 rate hike situation right now, with a lot of people calling for 7 or 8. But I think it's going to be tough for the Fed to raise rates that fast in this environment. And that's not necessarily going to be a good thing when you look at people's concerns around inflation outweighing um, worries about Fed rate hikes at this point. So it's going to be an interesting backdrop for the market this week. And, I'm curious to see how aggressive people want to trade this ahead of time. But the problem I see is that I think at the end of the day, come Wednesday afternoon, Thursday morning, people are going to be aware that we're in a weakening economic environment, and the Fed's going to be kind of forced to continue to raise rates and aren't really going to be in a position, as Brett said, to put in that Fed put, and it's not a great place for the markets to be in. And I think you're kind of seeing that play out in the price action here. Um, there's a lot of oversold conditions that I've been looking to see if we could get any sort of a bounce in, but no one's been wanting to step up to the plate in any of these tech names that have been getting decimated. Uh, and even the names that are performing well, like the oil names, you're starting to see some profit taking coming in. And my assumption is that you're just going to continue to see people move closer to the sidelines. And the big thing is going to be, of course, what kind of information are we going to get from the sell side conference? One of the positive drivers for the markets had been the idea that we could see earnings grow about 8%, I think it was year over year was the number for 2022. And that's going to start getting reined in a lot as we're going to see growth get choked off due to all the supply chain constraints, not only in China, but also due to the Russia-Ukraine situation, inflation rising, driving those costs up. So even from a valuation side where you were starting to get people a little bit more comfortable with the valuations, that's going to get reined in. And it's just making a very difficult environment for anybody wanting to step in and buy right now.
All right. So, with all that said, Gavin, how are you strategizing for this? Or what are some of the sectors or asset classes that you're really focused on?
Definitely looking at pullbacks in the energy sector here. Um, I'm looking for opportunities. I think that there's still plenty of upside when you're looking at the valuation in some of these names. Keeping an eye out, of course, on the government conversation around this. We've seen lots of talks about Biden looking to put in a tax on a windfall earnings tax on the energy names. I think that's part of the reason why we've seen them pull back a little bit here. But I think that there's still a strong upward trend in those names, so keeping an eye out for that. Consumer discretionary is not something that I'm particularly interested in. I know, anecdotally speaking, I was out to dinner on Saturday, and the conversation around the dinner table was how expensive everything's gotten and how people just simply don't want to go out now. And I think you're going to see that in terms of a dry up in demand. And we've been talking about that being a key issue around the supply chain constraints moving forward, where supply chain constraints, you're okay with them if you have a chance to work through and the demand remains. But if that demand all of a sudden starts drying up, that's where you get the build out of capacity to an area where all of a sudden that demand's not there, and you're seeing people with sunk costs. So that could be a rising concern as we start getting deeper into 2022. And consumer discretionary, I think, would be an area where you could see an outsized impact. So looking for some short opportunities in that sector. Financials, some counterparty risk when you unplug a $1.6 trillion economy from the global markets. While exposure to Russia has been light for a lot of these financials, there is going to carry some counterparty risk, and that's going to be going on while we're seeing the front end of the curve on the rise due to the move in central banks. So, financials are interesting here, but I think that that's going to be another area where you're going to have to kind of stay away from until we get some further clarity on the fallout from what's going to go on around all the sanctions in Russia and how that's going to impact the financial institutions. So it's tough to find areas that you're going to be really excited about. I mean, the energy and materials space will probably remain in demand in the story for 2022. But anything outside of that, I need to see some signs of at least a seller exhaustion or some money start put in play. And we really haven't been seeing that yet. As Brett was saying, pretty much any offer that you see coming in or any bid that you see around a turnaround is quickly met by a lead blanket of selling. And until we see that ease, it's tough to get excited about too many spaces here.
All right. So I'm going to bring in Trend Tracker into the discussion here. And Craig, you follow these high growth names and they've come in quite a bit. You follow valuations on these names and post them regularly for our listening base and our audience. So, how are you strategizing through this? Because a lot of your names that you follow have been quite hit. I know you've navigated this really well, but how are you doing it and what are some of the things you're looking for?
Well, I am just trying to focus on the companies that are profitable and do have healthy margins at this point, because we have seen, since the Fed pivot back in November, that if you aren't making money right now, the market just doesn't like your stock. There stocks like Twilio or Okta, stocks that for years, investors were able to look past the fact that they were going to keep investing in growth and operate near break even. And the market just wants nothing to do with that right now. If you're not making money, if you don't trade at a reasonable multiple of 2022 profits right now, then your stock is in the dumps. And even a lot of high multiple stocks that are growing profits, growing the top and bottom line, even the high multiple ones that are profitable are under pressure. So the war with Russia and Ukraine is really only increasing the inflation risks, which makes the outlook for these stocks less appealing. If this Russia situation wouldn't have happened, I was expecting inflation to start to cool off a little bit this spring, summer. But obviously the Russia situation is making all the inflationary risks a lot worse. So my expectation is that these growth stocks are probably going to remain out of favor here for some time. So I have been kind of focusing on the ones that are just profitable and do have some valuation support. I highlighted some of those GARP names this morning. And, it's not to say that the stocks that trade on a sales multiple alone will never work again, but I think they are going to require some patience. So in the meantime, I am going to be focusing more on tactical shorts, more intraday opportunities, because that really is what you have to take, because that's what the market is giving. The market is giving to us with the VIX at these levels and these wild swings every day. So I did have a short in Asana last week and had one this morning in Moderna. So yeah, I think we just have to you obviously got to take what the market is giving you, and you can't will anything else on the market. So definitely, remain cautious. I sort of take a back seat to Brett, chart trader, when he's bearish and short the indices. Then that doesn't mean you can't take a longer time frame view and invest, but my near-term outlook remains cautious because that's what the market is telling us to be for now. So.
All right, well, let's talk a little bit about some of your favorite names, ones that you've held for quite a while, and we'll start with TTD, the trade desk.
Sure. So this one is hitting new lows here, and it's it's an advertising business, so they're not immune to an economic slowdown or a recession. But if you zoom out, look at a longer term chart, it is kind of coming into longer term support. It's now below the flush lows from late January, and it's going to then be approaching the lows from a little less than a year ago. I do think that any weakness is a buying opportunity for the long term. I like the stock at these levels. I'm trying to be patient before buying more because, as I noted on Friday afternoon, there's just no bid in any of these growth stocks right now because everyone is kind of just waiting for signs of a turn. So without a big capitulatory kind of bottom like the one we saw in late January, it just feels like why buy if you can get a better price here near term. But I do think it's worth buying at these levels, but I think most people in growth land that has been just beaten buying dips for the last 6 months or 3 months have kind of learned their lesson against trying to catch a falling knife. So I do think this stock is increasingly attractive, but the long-term outlook remains very strong. But yeah, I'm just trying to be patient.
How big of a position do you have on in TTD Row?
Well, it's one of my biggest positions because I was very heavy in this one, split adjusted like $5 a share, right? So I kind of trimmed over the years, but my cost is very, very low in this one, which is why at 60 or 70 I wasn't trying to be too aggressive because again I own it from so much lower. But it's in the 50s here. It is screening really well. Again, not necessarily the layup that it was soon after the IPO in 2017, but in the 5 years since then, we saw this massive cycle and sentiment on these software stocks go from mediocre to clearly way ahead of themselves last year. So it's the bubble in a lot of these growth stocks got popped. So just like they kind of overshot to the upside last year, it's reasonable to assume they can overshoot to the downside this year. So I am interested in nibbling at these levels, but again, I think we just need to be patient because if inflation continues to be the biggest risk, then growth stocks are going to remain under pressure.
All right, and then a quick update on Upstart. This one has come in a bit since its last earnings, so let's chat about Upstart, UPST.
Yeah, so this one isn't as clean of a story as the trade desk. It's a little bit more controversial. We've seen it get crushed here in recent days and weeks, kind of following what Affirm has been doing. Affirm has gotten crushed as well. Now, I am generally cautious on the buy now, pay later space where Affirm is a leader, right? And Upstart, I do think, is kind of misunderstood. I think they're going to continue to post strong results. Now, fears of a recession are what are really kind of weighing on this. I think Upstart is kind of getting thrown, coupled with a lot of these other fintech stocks. There is credible risk from the fact that one of its biggest partners, its largest bank partner, Cross River Bank, has been fueling the growth in a lot of these fintech companies. Like there's shorts out there that kind of lump them together with the buy now pay later space. I do think that it's kind of unfair to Upstart. It isn't a bank. They aren't holding any of these. It's not really a lender. They don't have any of the balance sheet risk, but they do sell a lot of their loans packaged, or the originators package them up and sell asset-backed securities. So, if that market kind of dries up, it could pressure the rate that they receive on their loan originations. So I don't think the Bears are going anywhere here. This is another one where I do like it at this level, and I'm tempted to buy here. But again, with the broader market dynamics in play here, with inflation rising and now even recession risk, given what's happening in China and Europe, that this one is it's going to remain controversial. So I have had a lot of success in this stock since the IPO a little over a year ago, and it was basically just buying it on pullbacks and waiting for it to get washed out, and it's getting close now. So I probably will add, if we do continue, if the stock continues to fall here under 100. But I do think it's going to continue to perform well, and it's a little bit misunderstood. The multiple is, it's not a bargain. It's not like a bank trading at 10 times earnings. So, it isn't immune to just general weakness in these high growth stocks like multiple compression, but there are a lot of shorts coming after it as well. I think it was 10 or 15% that I mentioned this morning. So I think again with this one, you just got to be patient and really buy it when it's washed out. And I think it's going to continue to work because eventually the company's profits and their continued strong reports are going to matter. The guidance for the year was conservative. So, unless the economy really does fall apart, we do slide into recession, this thing is going to work from these levels, in my view.
All right. Well, one of the things that Trend Tracker mentioned was that he is focusing more on intraday setups, and that's pretty much what Blue Chip Trader does on a daily basis. So, Blue Chip, no reason to adjust that strategy right now, is there?
Yeah, no, not at all. Sorry about that. I was on mute for a little bit longer than I thought. Um, yeah, this environment, let's just kick it off with volatility, uh, or at least where volatility comes from. And I did kind of highlight this on this morning's technical take column that I posted, and it was titled, "The Market Always Despises Uncertainty." And, and I'm not going to go into all the headlines that everyone's been discussing and knows about already, but from Russia to Fed hikes to delisting or potential delisting of Chinese related names to rising gasoline prices, inflation, you just, throw everything out there, every worry out there. There's so much uncertainty regarding how these things play out in the long run that it is very difficult to assess the risk of investing behind those and finding the right asset classes. And when large institutions and portfolio managers have a struggle to define their risk on anything, they tend to not invest in that. They tend to seek out alternative investment vehicles, or they go to cash. And that's basically what we've been seeing going on here significantly over the last couple of months. Um, when you move to cash, obviously, the markets tend to come back in a little bit. The liquidity dries up in the market, and that creates faster and more looser trading conditions. And as a result, volatility spikes and goes higher. The VIX itself, if you're interested, the 10-week average for the VIX has been steadily on the rise here for the last 2 to 3 months, is currently around 26. That's the 10-week average of the VIX, which is a measure of volatility at 26. Normally, under bull market conditions, this sits well below 20, usually somewhere in the teens. And it's been on a steady rise here the last couple of months. Anybody that's experienced in trading and understands the markets, they recognize this developing over the last couple of months here in 2022. and they have already made the necessary adjustments to their portfolios. They have already made the necessary adjustments to their trading strategies and approaches to the market. It's no longer a favorable rising tide lifts all boats sort of environment. It is much more of you need to be focus on the trends at hand, and you need to be adjusting for the heightened volatility that comes with that market. And the faster you've adapted to that, the more successful you have been. I have received numerous emails. People are struggling. There's no doubt about it, because they haven't changed their style or approach to deal with the heightened volatility and the day-to-day whipsaws. They haven't shifted to more of a short-term tactical uh, approach to the markets. They're holding on to positions much longer than they should. They're averaging down into positions that they should not be, that they're in significant downtrends. They're not focusing on the strength in the market. The certain areas like commodities and miners and gold and agricultural names, even some infrastructure plays and steel stocks are doing really well. They're just not, they're focusing in all the wrong groups, and they're trading all the wrong names and all the on the wrong sides, and they don't have that mentality that they should either be focusing on the trend and really taking advantage of the two-sided opportunities that are out there. Now, the major indices are all below their key moving averages, the 50 and 200-day moving averages, which, as a technician, that kind of raises a big red flag. That's like the final red flag if you didn't catch on any of the signals before that, that we're in a more bearish environment, trading below those intermediate and long-term approaches, which again, that usually coincides with higher volatility that requires necessary adjustments. And that's really where the opportunities lie, and that's what I've been focusing on. It is a sell first, ask questions later environment. I know a lot of traders that basically within the first 30 minutes or hour of a trading session that are fading strength are doing very well. Other traders who are basically waiting out for opening ranges to get established and then waiting for those breaks to happen, either to the upside or the downside, are also doing very well. Um, Me myself, I've been focusing mostly on the underlying sector trends that have been at hand here. I do play contrarian moves. I'm not, completely one-sided trend follower in that sense. I do think when things get a little bit extended and more in a parabolic fashion, like we saw energy stocks do last week with crude hitting 130, that it got a little bit too extended to the upside there after a multi-day run up in some of those energy names, that I was willing to start fading some of the names on the short side. It's not easy to do that by any means, going contrarian, but I think it was the right call, that the momentum had been dying out. And it's very difficult to kind of zone in on one particular stock to kind of say, hey, you have to go down. Usually you're better off going after a whole basket of stocks, or maybe even deploying some sort of more strategic option hedge or option strategy around to take advantage of those sort of turns. Chinese stocks, they got beaten down here significantly over the last 2 weeks or so. We had the JP Morgan, I think it was, came out today, downgraded a slew of them, and caused a further gap down this morning, extending last week's losses. That just set the whole group up for a contrarian bounce here this morning that I highlighted off of the BABA trade. And again, a few of you wrote in, caught the turns, made a couple points to the upside for the contrarian bounce as a day trade, because that's exactly the tactics that we're using. Where we go from here on some of those names, who knows? I don't know if they're going to finish strong this afternoon. I don't know if they're going to roll back over. But that's not really a concern right now in the market. The concern, because the VIX right now is at 31. That's just not, it shouldn't even be on your mind that whether you should be holding on to these positions or not. So basically, that's it in a nutshell. It's a very skittish environment, and you have to just kind of take this short-term mentality to get in. And when you get a few points, you get out. And if you don't get a few points, you get out. It's just this really short-term, quick hit sort of mentality. And that's the way I've been surviving in this market the last couple months, just kind of going right after all that. So, yeah, if anybody No, I don't know if that's pretty much all I have to add here to that. Bigger picture, I would just say sentiment wise, things are very bearish. Obviously, we are at elevated volatility levels. The AAII sentiment data is at some of its lowest readings in weeks. The fear and greed index is also at extreme bearishness. So we are at this environment that not everyone's kind of, really skittish at this point in time. We can easily continue to slip lower. I don't see any sort of real improvements on the horizon here. We got the Fed talking here this week, so maybe we get some sort of reprieve and some sort of selling pressures, and we see some sort of bounces develop. Maybe we don't. I will say this though: bull cycles have always started from bearish activity, bearish environments. And with the Nasdaq QQQs 20% off their highs, the S&P off 14%, all the indices below the 200-day moving averages, extreme bearish sentiment. We are poised, bigger picture, for some sort of comeback. I'm not going to say rally, but we're poised for some sort of comeback to take everyone off their guard and kind of make them think that the worst is behind us. I think that's going to lead into some more of a multi-month sideways range, a very volatile one. I've talked about referencing the first half of 2015, the first 6 months of that time frame, as a sort of framework that you should just kind of go back and remind yourself how the market behaved during that early 2015 time frame, where it was going up 10, 12% for a couple weeks and then down 10, 12% for a couple of weeks. And it did that for about 6 months, 7 months. And I think we're just kind of long overdue, 6, 7 years overdue for that sort of environment. And I think you have to really kind of plan out how you are going to approach that sort of environment, because I think it's here to stay for a while.
All right, I have a generalized question for the team here. Now, one of the things that Trend Tracker said is that he kind of leans on Brett's analysis as to where he thinks the market may be headed. If he's got somewhat of a short bias, then he might be looking for more shorts on the, more tactical shorts to do on the intraday basis. I'm curious, how much do you guys lean on each other as far as ideas and idea generation? I think it's important because we have a whole group of a whole audience and subscribers who are leaning on you guys. How do you guys implement each other's strategies into the mix of your own trading?
I'll go first. So this is Blue Chip. So a lot of times, I think the key thing to understand that when you do read all the different trades that we're posting out there and sharing with everyone, is to understand the time frame first, because sometimes we do go against each other's uh, approaches and stuff. But you have to realize that some of us are scalping. Chart trader, he definitely tends to scalp futures and some commodities from time to time. So you have to pay attention to how we word our trades on the site. Some of us are day traders, some of us are swing traders, some of us are, more of a longer term position traders. So understanding time frame and how we word the questions is super, super important. Don't just read the headlines that mention the trade itself. Read the bullet points below to see how long of a time frame we have and how much risk is on those trades. That'd be the first approach. As for integrating it into my opinions and stuff, sometimes I'm looking at things that other traders are focusing on. Sometimes I'm not. So sometimes I use it just simply as idea generation. And if, for example, Event Trader mentioned the long in the FAS today, which is a triple weighted financial ETF, that brought to my attention that I should be taking a look at other financial names. And when I looked at my screens, I clearly saw that. I also knew technically that a lot of these names were beaten down: J.P. Morgan, Goldman Sachs, Bank of America, Citibank, etc. And so I quickly, scroll through those 8 to 10 names that I normally look at when I look at financials to see if there's also an opportunity there. If I agree from my analysis, from which is really technical oriented, does it warrant me to take on such a risk that event trader for the same reasons he's doing, which is probably a little bit more surrounding the economic situation and the Fed meeting and whatnot. So I kind of it's another piece of the puzzle. Everything that every trader posts on the site is another piece of the puzzle. Trend Tracker, fantastic researcher. He's like I said, he's one of the first guys I've ever seen, go after Tesla many years ago when it was trading below 40. The Trade Desk, same story, and multiple other names. Technically, I'm not a big fan of buying stocks in the downtrend. I kind of respect the bigger motions at hand. I understand there's value there and there's names there, but like you just said, these companies are still making money and they're being sold into. So what I do is I take a piece of paper and I write down the names that he likes, and I just watch the trends and I keep focus on them. And when the tides eventually do turn, I want to make sure I'm still involved in these names. I'll hit him up and say, hey, do you still like the Trade Desk at these levels? And of course, he's probably going to tell me he liked it, 10 points lower because the stock has already been rallying when it broke the trend. But that's neither here nor there at that time. I'm going to be jumping on the momentum and the change of trend at hand based upon the weekly charts and the turn. And I'm going to capture the meat of the move, that next leg higher, and participate with the fundamental story that he did the research on. And I'll have my own technical research on that stuff. Chart trader again, shorter trading on the futures. It's always very helpful, even if you don't trade futures, just to know how he stands and his opinion on the market. Kind of keeps my itchy trigger finger from hitting the buy or sell button on a particular trade that maybe I was looking to set up, and maybe just kind of hesitate and look for maybe a better entry, waiting for the market to break a certain direction on a day trade. Event trader, again, more economic based and fundamental based, as well as a little technical, a little best of all worlds there. And again, sometimes I disagree with them, sometimes I don't. But I just try to incorporate all of it. And I think I probably just spoke for almost everyone here. So I apologize unless somebody wants to add in something at that point.
Yeah, you pretty much said everything.
Nobody uses my stuff though, right? I piggyback on the shoulders of greatness, right?
Yeah, no, you said pretty much everything that I wanted to say as well. But I mean, so and one of the things that you said I think is really important, which is it's different in different times and different moments, and I think we're all probably like this. We all have our sort of sweet spot markets, and we're really complementary pieces. It's evolved that way over a lot of years to kind of be this jigsaw puzzle of different strategies that fit together really well, and I think that's one of the reasons why we really benefit from each other, because there are times when I really know what's going to happen. I just know what's going to happen. And there are other times when I have no idea. And one of the things that's been best about my personal evolution, and by the way, this is chart trader. I should have introduced myself, Brett. One of the things that's been best over the years about my personal evolution is is being better and better at distinguishing between those two states. When I really definitely know and when I don't. And I think a lot of the trouble people get in is they're not sure whether this is a moment where they really have an edge or when it's not. And I've gotten very good at knowing the difference between those two states. But when I'm not sure, the more that I listen to these other guys and the more that I kind of explore their views, it helps me get sure, because I know that I can trust what I'm getting, and I understand how everybody else here looks at the markets, and everybody has a different window. And knowing what that window is and how they're seeing things tends to tends to make it easier for me to suddenly get my claws in to the picture and get a grip and understand what's happening. And then once I get a sense that I've got an edge, and I feel like I'm one step ahead of the market rather than one step behind the market, I tend to start to trade a lot more. And I definitely feel like there's been a number of periods over, especially the last few years, where I've gotten my claws in because of something that somebody else on this team has said or done. And it helps me orient, because I know how they think and I know where their edge is. And when I start to see conviction in something and I trust their experience, it helps me start to get my claws in, and then I stop listening to people at that point, and until it stops working. So that's my side of this.
The only other thing, this is Event Trader, that I'd add in, that's extremely helpful, and I know Scott was talking about some of the other stuff that people do, but what he does, that TA page scan that he posts on a daily basis, I always like taking a look at that just to gather some ideas. You know, depending on where my mindset is in the market, either if I think that we're a little bit overbought or if we're oversold, you know, I'll definitely, my eyes will move to those scans. So it's important to kind of keep an eye out on what he's posted in there, and that'll give you a plethora of ideas to really move off of, just to help you set up the day, because it's really hard to just kind of keep an eye out on the entire market there, obviously, especially now given the volatility. I usually like trying to keep an eye on some sectors, and then if I see a sector that's jumping off, to be able to jump in and do a little bit of a deeper dive on those names. But Scott's TA page scan is a great way just to get a list of tickers that could match up with your mindset and get ready to play.
Well, thank you, Gavin. I appreciate that.
Hey, and just to double up on that, Scott, in case you didn't know, on days in which Gavin or you aren't around to help me in the pre-market chit chat, I go right to the TA page and say, "Hey, let's see what is on this one. Let's see what we can gather. Let's put some trades together." And I focus right on that because I know people are familiar with that. And I
Hmm.
always say that's a great place to start. You can start with the easiest of trades, the pullback, the doji, whatever fits your mold of
Hmm.
where you are, and it's a great place for beginners, but people who are savvy, who might know this, are looking for ideas. There are always pretty liquid stocks that
Oh yeah,
people
that's a
can,
requirement. Yep.
yeah, that people can get involved in. So yeah, I just wanted to extend that as well.
Thank
I
you.
do that all the time when Gavin or you aren't around in the pre-market.
There is one downside to the TA page scans, is if you're not familiar with the tickers. Again, it's ticker based for ease of use. I've been in the market so long. I think I know 95% of the tickers. Every now and then I get a few that jump on that I'm not familiar with, but that's a good thing because sometimes the new ones, they force me to go look at a new sector that might be up and coming or getting hit really hard. Like for a while there were a bunch of SPACs that jumped in there. There were a bunch of marijuana plays I wasn't familiar with a long time ago. Blockchain and NFTs jumped in there at one point. A couple of these EV plays, that I wasn't familiar with. So there's this constant rotation throughout the year. It's nothing too complicated, but it's usually the same names over and over. Um, Recently, actually, a subscriber, and I don't know if they're listening now, they asked me to highlight the ETFs. So I started bold facing the ETFs, and yeah, it takes a little bit more time, few more minutes of my publication time to add to that. But uh, looking at the TA page, you'll see that there are bold-faced tickers, and those are all either sector or thematic industry margins, major industry ETFs, and you can usually get a sense, even if you do anything, if you don't really look at like which ones are more bullish or bearish on the scans, but if you just kind of look at anything on the table now, try to zone in on those the bold-faced ETFs, and they're just giving you a really standard textbook pattern bias of whether they should be going higher or lower uh, within a short time frame, within either a day or two. That's usually the way this whole table is set up, for mostly within a day or two of getting a trading opportunity out of there. And why was I bullish on bullish on Chinese stocks here this morning? Well, look at the oversold candidates. It was at least, I think, 50% of the oversold candidates of the 30 that 40 that were posted were all Chinese related companies, including the KWEB, the FXI, the CWEB, the MCHI, and then go look at the wide range breakouts, which is bullish from Friday. It was the Yang, the YANG, one of these triple weighted bearish contrarian Chinese ETFs. And then look at the breakdowns. It was like all Chinese ETFs again. So we just kind of knew that from Friday's activity, this entire space was completely oversold and heavily distributed. And then when they gapped down today on that JP Morgan downgrade, it just set the group up for a solid opportunity to go in and play that contrarian trade there. You know, you can also look back up at the pullback long candidates for today. You have the last three ETFs, UVXY, VIXY, and VXX, the three main volatility ETFs. When they're on pullback long candidates, that's a bull flag. That essentially means that the volatility is poised to rise, which means that the market's probably going to be a little weaker today. So you kind of already established this bias that based upon the setups, the technical setups, that the market was probably going to struggle today, and you probably wanted to lean a little bit more short on a bigger picture basis. Does it work every time? No, but if you start to see the pattern play out after the opening, you can have a little bit more confidence that there is this technical, force at works here to be a little bit more leaning on the bearish side of things. And of course, as I'm speaking, it looks like the market's sliding lower. So
Yeah, I was just gonna
yeah.
input that. Looks like there's a news story out here from the Financial Times that the U.S. has told allies that China is open to provide Russia with military support. Again, that comes from the Financial Times. So looks like that is impacting the market here as we press on to fresh session lows. Here we trade 41.74. Trend tracker looks like you're covering your Moderna for a 10-point
Yep.
gain. Nice job there.
Just to add on to that China headline, don't forget the U.S. and China are meeting in Italy right now, so there's probably a little bit more verifiability behind that headline, I would say.
All right. Well, we'll definitely keep you posted on that. Scalp trader, you've been way too quiet over here, so I know you've been listening. Why don't you jump in and talk about what you have been developing? I know you're venturing back into some of the high yield space, so let's talk about it.
Hey, Jim. So yeah, I actually wanted to hold back a little bit since I knew I was going last, and could talk about segue into my piece of the conversation, and also talk about the last subject you brought up. Yeah, I mean, I think that as I sit back and watch the site each day, I'm just really impressed with just the overall skill set. I mean, I think we've purposefully built this the product around having a variety of different skill sets, and some so that we have multiple strategies that are working in any type of market. And I think that really shines through, especially in a market like this, when you look around, and I don't think there's many people out there who can operate in a market that's going down. I mean, I think most services are basically trying to trade penny stocks and dollar stocks short term, and kind of when the tide goes out, they continue to force the issue rather than allowing, well, if they don't have other people on the team that do other things. So I think there's just a lot of value there, and I'm just really impressed by the idea generation. And so, for me, this is not my ideal type of market. So I've been trying to add value by, just interpreting the news headlines and just staying on top of, the different moving parts of what may be impacting the markets, while also just doing my own research. Just over the years, my strategy has, obviously my name is Scalp, and I've done a lot of scalping over the years. But my strategy has really evolved into kind of more of a home run hitting, depressed market type of strategy. And so when I see markets crashing like this, I get pretty excited, and I know that there's going to be tremendous opportunity on the other side. So, and the fact that we have guys like Chart and Event and BLUEX who can carry the ball, while someone like myself or Trend kind of sit back and wait for a more compelling market environment, is pretty amazing. So currently, one of the things I'm paying attention to is, well, let me go back to in terms of how we use each other. So during down markets, I have historically done really well with Trend's IPO ideas. So typically, when the IPO market gets clobbered like this, you'll see valuations compress, and new IPOs will come to the market at very attractive valuations. He always does a really good job of identifying some of these names that people just literally just stop looking at IPOs. They don't want to touch IPOs, and there's always a diamond in there somewhere. And he has done a really good job of identifying those types of names. I have done well using charts analysis of the oil market. I like to trade depressed energy names. And it seems like they've been depressed for, until recently. I mean, they've had several kind of major crashes. And so our chart has always done a really good job of identifying the turn in oil prices. And so I've definitely used that analysis to help me get aggressive with energy names in the past. And so, the other guys I use actively as well. But in terms of kind of my core strategies and strategies that I feel the most comfortable with, being able to, use oil and then identify depressed names in the oil space, as well as IPOs, the kind of the future growth names of tomorrow. Those are kind of my bread and butter. And so I use those guys' ideas in particular. So one of the names I kind of wanted to point out is a name I started looking at today. It's had a little bit of a run, but it's one definitely to put on the radar. It's called CVR Partners. The ticker is UAN, Ugly Andrew Nancy, and they are a nitrogen fertilizer producer. So they benefit from the higher grain prices and Russian fertilizer export disruption. Recently, they raised their quarterly dividend to $5.24 per quarter, which is $21 per year. The stock trades around 107 right now, so that's about a 20% yield. No, UAN is the ticker. And so this is one I actually started paying attention to today and starting to dig into a little bit, but definitely wanted to put on the radar. I mean, 20% yield. It looks like they actually raised the dividend, the distribution before Russia started to warn of reducing or cutting off fertilizer exports. So they were in the past just benefiting from higher grain prices and supply demand imbalance. And so since Russia and Belarus, I think, are in the top 2 or 3 exporters of fertilizer in the world, you could continue to see their distribution go higher. Trying to think what else is on the radar. So again, I think that at the end of all of this, I mean, when you see this type of downdraft in the market, there's typically really compelling opportunity on the other side. I'm doing my research and just looking for names that I want to own long term. I think there will be big winners coming out of this, and really just trying to be patient and just tactical in the meantime.
All right. Yeah, that's a very interesting one there, Scalp. Very nice looking chart too. So I think Blue Chip would even approve of this one. So
I approve.
all right.
Looks
So
great.
UAN CVR Partners. All right. Any update with SPACs?
SPACs. I mean, I'm going to make a lot of freaking money in SPACs, and pretty confident in that. Sometimes, it's a new asset class, so sometimes it takes a little while to kind of get used to just how they play out. But I feel like now that there's going to be opportunity to make even more money than I thought before, because they're crashing so hard. And so I'm super excited about SPACs. I've been a little early, and I've played them on many rounds, right? And this is the first round where I kind of got my head handed to me a little bit. And I mean, even when I say that, though, I mean, some of these things have unraveled further than I expected, because the party stopped, right? So the reality is that most of the time, it's just a big game of musical chairs. And I've kind of been saying over the past year that I thought everything was overvalued and the tide was going to go out at some point. But in the meantime, you play the game. I was super cash heavy. And, when I look, I'm down 3% from my highs, right? Because I've been so heavy in cash and so bearish on the overall environment. So some of the SPACs have, the timing in terms of entering them wasn't ideal, but that's just kind of part of the game, right? But the fact that they are crashing so hard is a beautiful thing to me, and it's going to create depressed opportunities. So things go down. I guess I'm not too stressed about it. I actually hope they continue to go down, and there are opportunities to buy, say, $10 SPAC names for 20 cents or 30 cents.
Well, you've always been good at uncovering some of those opportunities, those distressed names. You did it way back when the oil market was getting crushed several years ago. So you've been able to snuff those out pretty well. So nice track record there. So looking forward to see what you find if that does present itself. All right, gentlemen. Well, I think we may be wrapping this up now, unless there's anything else to add, anything that any stone left unturned.
Nothing for me at this point.
All right. Well, I will assume that everything you guys wanted to say has been said, and I will throw it out to the listeners. These guys are pretty good about getting back to you. So if you do have questions, email them or send us the feedback. The most important thing is make sure you leave an email for yourself that we can respond to. That's always very helpful. If there's any follow-ups or additional questions, some more insight that you guys may need out there, these guys are always available to address some questions and trading related issues. So, with that said, gentlemen, I want to thank you guys for joining us. I want to thank the audience. It's been a great conversation. Appreciate you guys all pitching in and spending some time here and discussing our themes. And we'll be right back at it next month. Thanks a lot.
Thanks, Jim.